I don't know what goes on in meetings in the NYMEX or the CME or CBOT, but I do know that they're liars. They're proven liars. They've been caught many, many times. They're drug dealers. There are a whole bunch of things. We can go a long story, but the short form is almost certainly there's a reason. And I've even gone public recently on YouTube releases, some of which are still to be released, saying, if you want a reason to buy gold in this year, you've just been given it. Get all your gold purchases done before those dates.
Hey guys, welcome back to Capital Cosm. Today, I'm super stoked to have Francis Hunt from the Market Sniper YouTube channel on the show. Francis, thanks so much for coming back on, my friend.
Delighted to be back with you, Danny. Thanks for having me back.
For sure. Well, before we get started, guys, I'd like to remind you to hit that subscribe button. We are doing these videos daily now, or just about 5 to 6 times a week. So you don't want to miss an episode. Hit that subscribe button, hit a bell notification right on the side so you don't miss an episode. Francis, let's just dive right in. It's been about a quarter, 3 months or so since we last spoke. What is kind of like your macro view of the markets, the economy in general right now? What are you seeing out there in terms of 30,000 foot view, broad strokes of the economy?
Oh, well, I've just finished our Substack. We're on Substack under the Market Sniper newsletter. That's going to be going out later today. And well, financially and economically, one of the biggest pops for me was, hey, we've been overstating the employment number over the last year. And in fact, we're going to take 818,000 jobs that we said were created during the last year, and we're going to remove them because it never happened. Now, I don't know if you're familiar, in October 2023, we hit the criteria of 2 negative quarters, which is the definition of a recession. So we went into recession. US went into recession, which often means the rest of the world to a various degree. And that's 2 quarters. So that would have meant you got the number in October for quarter 3 that ends September. And that means the previous quarter, quarter 2, was also negative. So you had quarter 2 of 2023, quarter 3, where you got the number in October for the month ending September. You went into recession. That's a fact. And we said at the time, there's always only ever been one definition for a recession, and it's 2 negative quarters. And actually, there was an unbelievable media surge, and Janet Yellen and all forms of new addendum rules that got bolted on, and that said, but the amazingly strong labor market. You can't be in recession with such a strong labor market. Now, first of all, I must remind people and point out that labor statistics are the largest lagging indicator of all, because you avoid cutting staff that you need because it's expensive. First of all, you have to pay a lump sum. Most instances, I mean, it depends by business and it depends by how long they've been employed. But you're looking at 3 months' salary at minimum that you've got to roll up. If you've got long-standing employees, could be quite a lot more. That you've got to roll up, so it gets expensive to get rid of people. You've got to be pretty damn sure that your demand is so down for such an extended period that you're not going to need a rehire, and you ended up blowing up a whole bunch more money. So when you decide to run lean, you've got to have thought it through and thought what's coming. So labor unemployment numbers is a lagging statistic. Despite this, they told an absolute fabrication, and we were. You know, I'm kind of got wicked humor and black humor where I keep scratching at things that I think are known lies. On nearly every, I can't say every, most YouTubes that I've put out on the Market Sniper since October 2023, I've been mocking the narrative of the red hot labor market. And I put it in my X tweets. I put it in everything. But guys, and we have live trading days on non-farm payroll release. We do it for a reason, and I call it fake number day. because of the birth-death model, which is an assumption based on trends of how many jobs you could subsequently add in, et cetera, all these things. And they try generate a data piece. And in fact, they actually continued that into the first quarter of this year. Non-farm payroll is really good. But what they were actually doing, they were already being forced to leak some of the truth out, is when they released a hot, good number, better than expectations or at expectations, they would revise the previous month and the months before quietly in the footnotes a whole bunch down. So we've actually seen an orchestrated lie where you met the criteria of a recession. It's defined. It's been that way since I've been in and way before me in macroeconomics. And they started saying, no, but not in this instance, and cultivating narratives. And then they said, it's labor. So they had only one reason on a lagging piece of data that they know they have an assumption-based birth-death model in. And more recently, we heard Powell saying, well, non-farm does tend to overshoot. So they started to leak their lack of confidence. So they tell a lie. When you lie, it's like a ship sailing very close to the coastline, where the coastline represents truth. It's actually stressful to tell a lie, even practice liars. So I've studied statement analysis and a lot of things where people have questioned key criminals on what really happened and all of the information you can get in how people choose to lie to you. So when you have to tell a lie, you go with your boat away into the deep blue sea, and then you come back as quick as possible to truth. And when you're going to have to navigate back to the coastline, you start leaking things. So it kind of looks more organic, your return to the coastline. And so Powell was recently, as I mentioned, saying, well, there tends to be an overstate. But hold on, if you knew that, why a year ago were you saying no recession, labor market strong? Now you're kind of saying, well, nowadays we're not too sure about the validity. So they've come and lost almost 1 million jobs. That's a 30%, 28% revision downside. I can tell you that not that long ago, and I expect the stat remains the same, the male participation rate in the economy. So that's people that are no longer counted as looking for jobs. If you're looking for a job longer than 6 months, you don't get counted as unemployed anymore. You just become this dude who sits on his mom's basement and plays video games, not serious looking for jobs, because we're such a vibrant economy that everybody can always find all the work and we're creating these jobs. So the biggest lie and the biggest economic drop is the fact that they left the coastline of any semblance of truth, if you believe that what they were doing before was honest, and they've been forced to come back. And now we realize that in actual fact, the labor market is not nearly as strong, and there's this big admittance to a major loss of jobs, or jobs that were counted as having been created that never were, on an assumption based. In other words, there's not a name and a person that signed on and got a paycheck and all of this. They assume job creation on account of new businesses being created and old businesses closing down. And there just wasn't that number of new businesses. Further to that, there were government jobs that were the bulk of the created jobs. And in some instances, government was giving money to an agency that's technically not government, who was then hiring a nurse, a doctor, or a diversity consultant, let's say, or a transgender, consultant of some form that works for the state. And they weren't being counted as government jobs, and now it's being found out that they're in fact funded by government jobs. So what we've seen is this massive overexpansion of government into all of these places it doesn't belong, at the expense, and there's an economic theory that talks about crowding out. So that money and expenditure that is going to hire a diversity consultant is now money that's not being spent on infrastructure. It's not being spent on a fresher airport. All the states' airport, I say all, most of the New York airports I've ever had to go. Compare them to Singapore, Dubai, Qatar. Let me tell you, they are awful. They're fresh out of the late 60s and the early 70s. And this is this is the country that has 4 or 5 companies that are trillion market cap. That's where you fly into the economic hub of the nation. So it's not going into infrastructure. I was in Miami The roads aren't being swept. There's tire carcasses in the road. The concrete surfaces are old. This is old infrastructure that was done a long, long time ago that's not even being maintained that well. But we've got money to give to Israel. We've got money to give to Ukraine for war because it's a military industrial complex ruse. So the question you asked, and I've gone long form on you here, but the key thing is, and the biggest, is the truth starting to come back out. We called it a lie. We never believed it. We referred to it as the fake number, and now it's been confessed to. So a big call that we made. You were in a recession. So now the question is, have you been in and out of a recession a number of times, or have you been consistently in a recession? Because you have to look at those growth numbers for each quarter and say, we went into a recession when we met the criteria for going into a recession. It's kind of, that's how definitions work. And that's the big realization. You are in a recession and have been for a while. And the notion that it's even surprising on the mega spike, very fast, higher for longer. So the next question is, so why have they lied, and why did they use labor to lie to avoid this? Because they needed, as Powell warned, higher for longer. So why do they want higher for longer? Well, it hollows out the working middle classes, the bourgeois, the future attack vector that government will come for on the middle classes, the bourgeoisie. And why can't they cut more than go right down to zero? Because the debt market turned in 2020. The debt market turned in 2020, and there isn't the bid under debt markets. So that's why it's been higher for longer. To actually drop rates significantly, back to my seesaw, to drop the rates, my elbow down, the valuation of the debt, my hand, has to go up. Who's going to be storming in to buy debt in America that's supposedly still meant to be considered risk-free when you have incredibly high inflation, massive proliferation in the last event, CV19, you've got a recession on your hands, and the consumers aren't buying, the tax receipts are going to drop. Yellen is creating 1 trillion every 100 days of new debt. It now becomes a case where scarcity certainly isn't applying to the debt markets. So how does high value stay there when the supply chain is getting ever bigger and the production is getting faster and more being churned out? And that's where I usually use my pink Crocs example. The first time Crocs came out and you could have a bright color pair, it was almost novel and cute, and check at me, my rubber shoes. But once you have oil tankers, a queue of oil tankers with containers full of pink Crocs, it's no longer a high value item. Everybody who wanted a pair has a pair. They're in every flea market, and they go from $25, $50. You can't give them away for $5. And even the homeless people are wearing it because they've been thrown away by the owners. So that's debt. It's proliferation of debt crisis. So actually, the interest rates are going to have a minor pullback. We are in a bull market for the interest rates, in my opinion, which means a crash for the debt valuations. And we're having a pullback period, potentially, if they have the cuts or they just talk about the cuts. How much you'll see, I don't know. But who's going to buy it? In the end, the Fed is already the biggest holder, and they'll have to continue to be. And the Fed we'll go from having toxic banks, commercial banks, that got all the garbage. AIG was a bit like that. They got to be holding the other end of all the bad trades and the subprime debt that Goldman Sachs laid off their risk on, and all the others laid it on, and they sort of propped AIG up. Now the Fed, one level higher, the central bank is going to be the buyer of last resorts in the debt markets at a time that the Treasury is creating $1 trillion every 100 days. So how do you deal with that? Interest rate spikes are going to come at some point. Whilst everyone is talking cuts, you will potentially get 1 or 2. You may even get 3 or 4. But the long-term trend is up. And that means people getting into debt are going to be squeezed out and not be able to make their interest payments. That is the great economic story for me. And that's why I think they lied, because they couldn't start cutting earlier and give you the cuts you need right back down. There isn't the bid. They know they'll end up the buyer. And the banks, final point before I shut up. The banks, the US banks, the European banks have also, we've got to talk about the carry trade. They've been the buyer of last resort. If they can't put it into pension funds, and pension funds are looking for different assets nowadays because the capital value of those bonds collapsed 45%, long-term debt, because of that interest rate spike up to 5%. Nobody wants to be that heavily exposed. So the primary dealers have to hold on their books. It's part of their mandate, the debt. So what do? The only way you can make money out of that is you borrow in Japan at a much lower rate. You pay a spread. So you 0.1, you pay maybe 1% or 2%, you get invested in treasuries here, where you serve your mandate to the American government, and you get 5 or 6% on the assets in yield, utilizing leverage and a carry trade. And we've just seen a degree of, and I don't think it's over yet. If you watch the USD JPY, I'm not sure it's over. You get a degree of unwinding of the carry trade, which may need another leg down. And that's a big X question that's hanging out there. So let me let you unpack some of that.
Yeah, to me, it sounds like we're in the middle of a doom loop. As interest rates continue to rise and and as the value of our debt continues to come down, wouldn't this spark an even worse form of inflation with the ever-growing interest rate? And I would think that once you hit some arbitrarily high number, people earning yield at that rate, wouldn't that just flood the money supply with, if I was like a guy, I could just sit in USTs for like 10%, 15%, 20%, whatever it is. I'm getting that return on capital, and then I spend it in the markets. That would also depreciate the dollar, because now you've got extra money supply, slushing around in the economy. Do you agree with that take, or no? Like, is there something I'm missing here?
Well, the problem people that borrowed in the cheap money, the yen, are facing now is when valuations in the equity market come under question. The retail, so I treat the economy as a twisted balloon. There's the billionaire class and the statist class, the Mag 7 that goes up on government contracts for doing Amazon hosting. They've been doing just fine, and their valuations have gone up. NVIDIA's in there. And then you've got the retail and the consumer part of the balloon. That one's been pricked and is deflating immensely. The problem is the twist is not 100% perfect. Amazon is still 52% a retailer before it's AWS and all the other things. And that means its consumer gets wrecked. It stops buying things on Amazon. That means DHL, FedEx stop delivering things for Amazon. That means oil price pressure, because there's no more flying, there's no more deliveries, there's less packaging, because oil's in packaging, it's in everything. So the inflation, one of the key things that I'm watching is actually the oil market. So we gave a trade, long gold, as the yen trade was starting to unwind. We said long gold, and the gold had fallen by 4.7%. We said long gold, short oil. That's a commodity neutral trade. So you could put 100,000 to the upside and sell 100,000 on the dollar oil price, and see how you do. And the play idea is the wrecked consumer, not buying, not traveling, business, less meetings in person, usual stuff we saw just before CV19. This is essentially the CV19 trade. And it's quite ironic that we have an MPOX narrative floating around as well as many other things, because the current oil price has a Russia-Ukraine oil baked in, war baked in, and an Israeli-Iranian acceleration pretty much baked in. It will react if there's a sudden flare up in any of those, for sure. But people already understand that there's quite a high hostilities and rates, yet it's still falling. And that tells me, man, the demand destroying event is not yet even begun to play. Then you talk about the yield curve reversion that is yet to have fully happened. So the 30s and 2s have reverted back above the zero line. That's usually the triggering event for soon to be named crisis. But the primary yield curve inversion that most people look at is the 10-year treasury and the two. And during the yen curve, the yen carry trade reverting and unwinding, we got a reversion of the difference. It's just touched positive and then it came back down. So we're already in a standby situation for a major event. It may be worth showing that chart just to
Sure.
break up the flow here, because this is something people will really appreciate if they can see visually. I'll do that if that's all right with you.
Sure.
So this is the yen, the USD JPY. This correction isn't over until, we start to see a proper rebound in the dollar. But what I was looking to show you is the US 10-year minus the US 2-year yields. So this is the difference you get paid in interest between long-term debt and short-term debt. I know you're familiar with it, but to many others, it will be a little bit like Greek. And the key part about this is there's never a yield curve inversion. That's when you go below the blue line, which is 0%. That doesn't lead to a major recession when it reverts back positively. So I've drawn and put a lot of annotations because I show this chart often. But you have, for example, 1989, you inverted when you went below the line. This was a big crisis for early 90s, 91, 92. You had the Asian crisis of 95, 96. You had a small inversion there. And then when you reverted, you had the Asian crisis debt. You had the 99 dot-com. You went inverted there and you broke back up 2001. This did for George Bush Sr. and got Bill Clinton in. You got the dot-com crash. You see, it's a leading indicator. Unlike the Fed's labor stats, which is actually a lagging indicator, it's the last thing people do. And by the time you get the stats for it, it's even later coming out. This is a leading indicator. This says people are no longer expecting super high inflation. They're actually take a lower yield on long-term money. That's why you're negative. The short-term money is paying a higher interest than the long-term money. And that's abnormal. That's a downward, as you go out the timeline, that's a downward sloping curve. It should be an upward sloping curve. Inflation works against you. If you're only getting your money back in 30 years' time, the compounding effect of inflation means the $1 million you lend to the government today, when you get it back in 30 years, it doesn't buy you near as much. So you demand a higher interest payment, a coupon rate during that period. That's normal. It's a very bad vibe when people go, oh, I don't like this, we're going into real trouble. It's disinflationary, and they're parking their money up more on the long end. Here you have the subprime inversion, and then you had Lehman's. This is the whole 2008 subcrisis. Here's the mid-2019 minor reversion, and then you got the CV19 orchestrated event. There was a repo liquidity problem that occurred around there. Now we've just had the biggest inversion, and we literally popped up to the north mark and then pulled back. But we're still very close. We're at 0.175 at the moment. And that's we're waiting to go back positive. And that's when you get the name for your crisis. So it feels to me like we're going to have a hell of a September, October, November, and people should be wary about jumping risk on. On a separate note, Bitcoin has always gone up when fiat is being proliferated. If you go to Bitcoin and its bull markets and the dollar, Bitcoin actually has needed, in the last two events, dollar devaluation immensely to do what it's done. And that's a real messy chart. I've got lots of draws on it. I'm going to choose a different one where I've got less alerts. Let's just go here. So we are anticipating, in fact, Bitstamp a little bit more history as well. Let's just see USD. Let's get Bitstamp up. So a lot of history. I'm going to log scale that. I've shown this before to my crypto friends, and we've always highlighted that it's actually flourished when dollar is weak. And we're just going into a weak phase. So I think this is going to go up, by the way. So I'm not being bearish. But if you look at here, this was a crisis, and then this was the 7 trillion that came into the retail market space. Bang. By the way, loans were given to European as well as American banks to the tune of 23 trillion during CV19, much larger sums than the subprime crisis, which was known to be a bank failure event. That reporting has gone real quiet. So you've looked at, this was the Shanghai Accord in 2016. That's when China hit the buffers and they needed a weak dollar to let the Chinese export their way out. They all met together in Shanghai, and it was not called the Shanghai Accord. It got nicknamed that by Jim Rickards. But there was definitely getting all the central bank heads together because China was keeping the global economy warm during the subprime events and was buying everything, and everyone was talking dominance China, and they were building, bringing all the copper. That's why Australia almost didn't have a GFC, only then to hit the buffers themselves and go for their subprime crisis in 2016, 8 years later. So they were hitting the wall. So weak dollar, you see Bitcoin runs. 7 trillion printed. That's when the big runs in Bitcoin actually come around. 2009, the collapse and the quantitative easing 1, 2, 3, and 4 that came during 10, 11, 12, and QE. So that's QE. That's the Shanghai Accord, the liquidity provision, and that's CV19. So it's actually awaiting, I think, a little bit of an event, and either the cut in rates will be enough, but I think there needs a liquidity event to really, really gas it strongly into the 150K zone. But we expect Bitcoin to go up because we expect that possible event to occur. So rate cuts, liquidity, and other events possible.
So do you not see that like that diminishing logarithmic curve on Bitcoin though? Like if you were to draw an arc, it seems like you're kind of at that inflection point on
the
Bitcoin.
Percentage gains are getting far more aggregated. This is what we'd call a convex curve. The ability to climb in percentage terms is far harder. I mean, the golden era of Bitcoin was, without doubt, the people that got in, that's when you made ridiculous sums, 2012 to 2014. I was around 15, 16, and that was our best memory, was the December 17 high. It's never been as pumpamental since. You've had to look at other smaller cap alt coins, and that's a lot trickier because they are now subject to Bitcoin going up and then their own fundamentals going up. So there's two links in the chain. There's 2 points in failure. You have to choose the right alt at the right time and have Bitcoin also be in the right state, because if Bitcoin crashes, generally most things go down of large cap status. I'm not talking about micro caps here. Yeah, so you're quite right to point that out. Its ability to go higher, faster is being challenged. Look, you could suddenly have a super spike. Don't get me wrong. The collapse of the financial system, the Jupiter, that is the quadrillions of derivatives and our economy, multiple hundreds of trillions in dark assets that are held and owned by the ruling families. Those things have to get deflated down in the old world. So they are already positioned in them to have that liquidity reflate up, and crypto will be part of that. So if we were to get a, total belief in Bitcoin and a very violent contraction in the old world, financial world, you could break out of this convexity and have a stab up that defies the trend. But I've got big cap alternatives to Bitcoin. I think it's not bad to have some Bitcoin in your crypto holding, but gold is my favorite. The key point I made about downside beta, everybody needs their money when everybody else needs their money, because it's macroeconomic. When, it's here, when they stopped everyone from working and they closed all your businesses, everybody needed liquidity there. You become a seller of Bitcoin at $4,000 or 3,900 and whatever, even if you bought at 10 or 14,000 up top here. So the key value of gold is its downside beta, which is the volatility to the downside. This is why volatility isn't always a feature, because most people stay in when they're making money. Greed keeps you in, fear, pain, and necessity gets you out. And it's usually when everyone else is in that same situation, because it's macroeconomic. That doesn't mean you can't have a personal crisis or financial during a good time, but most people become forced sellers here. And gold went down 4.7%, very quickly went back to its previous high, and is now recently made all-time highs. So you're better off than the yen before the yen carry trade unwound.
Bitcoin do you want to pull up the gold chart?
Yes. And just before I leave the Bitcoin chart, so we do Bitcoin first, then we'll go over to the gold, if that's okay, because we got Bitcoin now.
Yeah, sure.
And I'll wipe my face a little bit there for my drawings. If we show you the downside vol on Bitcoin, we called a run on our crypto snipe, and we said you will be capped on your capping descending grind line. That's that red line there. I'll make it fat for everybody. And the 70,000. And you literally wick traded that, and then the yen carry trade news started to come in. So you fell from 70,000 right the way down. And the difference in percent, and we'll measure it together in the downside vol, if this what turned into a real shocker event like COVID, and you were told, listen, we don't have a job for you anymore, was 30%. You probably can just about see that. There you go, 30% at the worst, from the highest to the worst. Now, you already recovered some of that, but you're still 14% down. So at your worst, 30%. Many people get shocked, unfortunately shaken out near the lows. So the downside vol was 30%, and you've only recovered almost 50% of it, call it 48%. If you look at gold, which is your question, and a very good one, if you look at that date, I should have just taken the date while we were on Bitcoin. One more second, I'll get it back up from the 70 high. Literally, I want to compare like for like. So it's Monday, the 29th of July. I'm going to take it from the exact same point on gold, and you'll see that. Monday, the 29th of July, that's 2nd of August. Close enough, we're on a daily, there we go. That was your pullback at worst, 4.62%. Right. And now you're beyond the high and actually higher. So Bitcoin is still 16% below that high. And you're actually, as of today, about 0.26 above where you were before this event. And you traded to a high over here. Now, bearing in mind that this is reset economics, this is what our specialty is, being prepared for reset. This is why we keep emphasizing the value of gold. The downside volatility is far more important if you're going to be a forced seller. Listen, if my income stops at all levels all of a sudden, and they do a bank hack, guess what? I'm needing to sell stuff. And guess what? A whole bunch of other people are having to sell stuff. What's your valuation then? That's how you've got to think about it. It's not selling in the good time and the pumpermentals. Most people don't know to take profits. As I say, greed keeps them in. So the point here is by being in a less volatile asset on the downside, that is a monetary commodity that will be absolutely flourishing as an arc to the new old train system, to the new monorail system, is actually gold. Because it has always been a monetary system before. In fact, debt and fiat was originally based on it. And then that link got severed slowly. A couple of the strings got cut, 1913, 1933, 1971. And next thing you know, it's just a free float paper thing based on faith. That's borrowed into existence, financialization of everything. We get a Ponzi scheme, the insiders are carteling. Now you can go back to original money, and gold has got to be part of that. Because if you have to sell it, if you sold it at the worst point with the worst timing, you wouldn't be more than 5%, 4.7% off your high water mark, which was a localized high. And if you could hold on a handful of days because you kept a bit of cash at home, you'd actually be selling it at an all-time high, on a high mark, while Bitcoin, you would have been selling it somewhere between 30 and 20% down. And this was a carry trade. This was a tremor. This was not CB19. And I think what comes, the main earthquake, can be bigger than both this recent tremor and CB19. So think about that 30% being a 75% and the 4% being first a 15%, but then later getting back up real quick, like it did during CB19. So this is how allocation and thinking, I'm trying to encourage people to think about, and the points. And I hope that's useful and interesting for your audience.
Yeah, for sure. How about silver? Gold's making new all-time highs, but silver's still like 40% off its all-time high. What's the story there with silver?
It's a good question. And the key aspect about silver is that it has a slight element of industrial demand as well. Long run, we remain exceedingly bullish silver, and at some point it will go up even faster in our take than gold. However, I suggest for people, the most liquid and the easiest storage right now is still gold, and then make the slow dough first. What I've realized is that this whole unwind is a play. It's a William Shakespeare pantomime play with many acts and sonnets to be said and songs to be sung and tales to be told. And the problem is we're all thinking, what's next? What's next? You haven't even enjoyed your starter and you're already asking what's for dessert, and you've assumed you've already eaten your steak. That's speed eating. You don't need to do that. We're having a dining experience of 3.5 hours with a great glass of wine and great company. Don't worry about what's next. Watch the phases play out, and the cycles are going to take their time. This is an unwinding of a multi-quadrillion financial system. Lots of things need to be moved. They need greater liquidity. They need their market caps pushed up before bigger money can even come in. All sorts of rules, regs still have to happen. And if so overall, will say to you, we think that silver will break this red line and that this is all a continuation pattern. So again, a bull post, a megaphone, a downward descending megaphone, which is typically in our read by HVF method theory, an upside continuation. That means the expectation is you will break this line to the upside at some point. But you're going to take a while to get to the other side. You're going to pass through the 30 zone again. That'll be the third touch, probably have a pullback. And then at some point we see that happening and go. But at the moment, if we look at the gold-silver ratio, we see a degree of silver relative overperformance, but there's also the possibility that this is going to take longer. We felt that it was coming closer to the point that silver would start overperforming, and then we turned out to be 100% inaccurate on that. It came all the way back, but it took a yen trade unraveling to do that. So we were saying, look, when you break out of this channel, that could be the beginning of the journey to the 65. That's our key level that we want to see broken, a key technical level. We thought we had it. We had that typical return move, a proper spill, but then it never broke below here. It got bid up. There's a hammer here. It got bid up, and then the dramas happened of the yen, and silver got hammered more. Why? Because economics are looking garbage. So because of the industrial component, copper was spilling. So before this whole yen trade happened, we said the USD JPY is turning down stronger than normal. It's a fear indicator. We highlighted copper. Copper was crashing. And then we highlighted yield curve reversion was getting very close to that zero line. We said there's something coming. And of course, the industrial, because it's retail and consumer crushed, people aren't buying solar panels for their homes anymore right now. This and this and this and this is not happening, et cetera, et cetera. So all of those things, copper getting smashed has a slight pull down on silver too, because of that industrial component of it. It's also got the monetary component, but not as much. It's consumed. Silver is consumed as well. And now we say, okay, this is looking more like gold could dominate a while longer. This looks like a continuation pattern, and going up for the gold-silver ratio actually probably means overperformance. So we might get back down to the halfway mark, but we think, okay, this is going to take a little bit longer. It's going to be, who has the money? The central banks do, because they print it up. It's not retail right now. So gold goes faster. When retail starts participating in a major way in the precious metals boom, because of them being smaller and smaller amounts, but much more of them, that's when I start to see silver outperform. But at the moment, that could be pushed out time-wise a little bit further. So we've moved our timeline out for that, and we say keep stacking the gold ounces for now. You're not going to be in the wrong place.
Yeah, on the gold and silver front, have you heard the news of the COMEX and the New York Metals Exchange changing their delivery protocols to mandate a production date on their gold bars?
Yes.
What does that portend to? Are they, some have speculated online that it could be a sign that they may start confiscating gold after a certain production date. Do you see it that way? Why do you think they would do something like that?
I saw both that announcement and I saw some of that speculation. And I think we should. So inherently, you ask someone like me, you have to know my bias. I see the state as a weaponized warmongery system that is actually not only weaponized against other nation states through orchestration, but is weaponized against its own citizenry. Anybody who participated in the events of March 2020 onwards that does not see the combination of big corporates and governmental organization as a potential attack vector learned nothing, in my view. And when you know that there is a Ponzi scheme and they know that we know and they know that they're lying and we know that they're lying, we're sitting in this poker room with some people complete patsies, but some people that are looking at the dealer and watching the sleight of hand, and they know that we're watching, and you know that we know we're watching. That we are, anything that they do is something to give them further tools and mechanisms for later hollowing out. So I have the Reset Sniper. We're a 3-circle brand. The Crypto Sniper, we touched on Bitcoin, the Market Sniper, which is the traditional markets, and both of which utilizing Hunt Volatility Funnel method, which is that dot in the middle on the overlap of all three. But the Reset Sniper brain says, I am exceedingly cynical and skeptic of government's role. They are captured whores, bought for by legacy money of multi-generations going back not just centuries, but potentially even millennia. And we are the problem, and they've let fly quite a lot of their thoughts in the open face for me to treat them with skepticism. You have the likes of the Deagle stats. I don't like too many coincidences. I start coming to the wrong conclusions. So when you ask a skeptic, a cynic, and someone who views government as an attack vector, something like that, I'm going to tell you almost certainly, even without knowing what it is that there is a reason for that will work in their favor, and that usually means against you. So I would have been probably front of the queue with that speculation. Of course, it's spitballing. Do I know anything? No. I'm sitting in here in apartment office here in Panama. I don't know what goes on in meetings in the NYMEX or the CME or CBOT, but I do know that they're liars. They're proven liars. They've been caught many, many times. They're drug dealers. There are a whole bunch of things. We can go a long story, but the short form is almost certainly there's a reason. And I've even gone public recently on YouTube releases, some of which are still to be released, saying, if you want a reason to buy gold in this year, you've just been given it. Get all your gold purchases done before those dates.
Are you in the market for gold and silver? Then if so, please consider Miles Franklin. They are my gold and silver dealer of choice. So not only do they have super competitive prices that you're going to have a really hard time finding elsewhere, but then they also have top-notch customer support. I know Andy Schechtman, the owner of Miles Franklin, top-notch guy. I wouldn't be recommending them to you if I didn't have faith in their product mode. What you really want to do, however, you want to email them at info@milesfranklin.com, and you want to say that Capital Cosmos sent me in the description line, because when you do that, you can get access to their special pricing sheet. You want to get that special pricing sheet because you're going to get special prices that you won't find on the website itself. So email them at info@milesfranklin.com. Tell them that Capital Cosmos sent you, and you won't be heckled with spam emails, etc. There's no commitment necessary. I promise you that. And with that said, I will let you get back to the video.
And longer run, don't forget, we have good old Larry, as I call him, or BlackRock, who biggest fan of tokenization, not so much of Bitcoin. He has to get involved in the token, and Ray, and it's transnational. What he wants is to transcend national boundaries for his new government, new world order government. And tokenization and digital ID are two parts of a very, very nasty triangle. And that is, you get identified exactly, regardless where you are, what nation or whatever, you have a number, and you have to KYC once and for all, biometrically, facial, eyeball, right down probably to your gait and all sorts of weirderies, so that they can always identify you, pick you up on camera, and know where you are, what you're doing. And then any asset of any significant value that you purchase will be blockchainized or hash graphed or whatever the ideal technology is, with a token and an NFT, which I expect, for your convenience, will have all the conveyancing documents readily available in the electric digital realm, and will have all valuations and everything else. Plus, should you ever choose to rent it out, an embedded rental agreement, so that the likes of BlackRock could proliferate the CBDC of the moment and actually purchase your property at whatever designated value it is, and turn you into a tenant in your own home. So I expect them to be able to search me by digital ID and see every registered thing that I've bought that gets put on the blockchain every time you buy. And retailers will start to make it even compulsory on big items that no, you have to be registered, and it'll all be there for your safety, but it's not hackable, and you know, all the usual narratives will be given, and it means you can sell to foreign buyers offline unseen, and they can check it out on all the network cameras, and you know, it's better for you, and all these stories. This is where we're heading, and that's how they get you to being, you will own nothing and be on their happy pills. And if you understand that, and you see a small item like this coming along, it's quite clear that there's probably going to be some rule-based system from 2025 that will see that date serve as significant. And for those that say, well, I can melt it, you might be able to melt it, but and recast it. You may have someone who has a workshop that can do something like that without losing too much of it. But the point of that is, there will come a point that I've predicted that there will be black gold, unofficial gold not registered, and registered gold, and there will be draconian, in the same way as they are emptying violent criminals out of UK jails to put people organizing a protest into a prison to find a seat. In the same way that they are doing that and trying to get social media people put behind bars, they will make a bigger crime and sentence for having unregistered assets than they would or other common criminal by far. And that's how they will disincentivize. By the way, when they did the 1933 confiscation, I think the amount that they could fine you was $10,000 and 2 or 3 years of jail. I stand corrected. Someone in the comments will answer. But that was when $10,000 was huge. It would be the equivalent of, you know, hundreds of thousands today. People had an annual salary of less than that and did just fine. You know, 4,000 or 5,000, you bought houses back then at 1933. So draconian consequences for people that own black assets, with possibility and rights of inspection on premises at a drop of a hat, unannounced, on the basis you might be suspicious of having it. So someone like me talking about this will probably go onto a list and get drop-in visits if I haven't sold the asset by then, for them looking around for dark gold, and we'll be tainted as the worst criminals of all, you know, the people that are stealing from the citizens because we haven't registered our gold and don't want to pay our fair share of capital gains. So this is what I see coming. And, it's pretty dark, but nonetheless, gold is still the right purchase. You might have to leave country as well.
Well, Francis, they don't call you the market sniper for nothing. What a way to close out the show here. I appreciate your time. Anything else you want to talk about? Anything you want to plug before we sign off here?
So some of this can sound quite dark. We're going through a totalitarian. The Rockefeller document went, it's lockstep stage, and that's totalitarianism. They outright state it, and you can find these documents. They're still up there. I think it was Agenda 2020 or 2023 or whatever the case may be. So freedoms are going. So here's what you need to know. You either recognize this and you already start seeing the signs around you and you join those dots and appreciate that, or you think I'm a nutty Fruit Loop and you think nothing's going to happen. We'll all push back. Everybody will suddenly get up and stop it. Well, you saw what happened on COVID. You've seen who's been arrested for false information and mass genocide. Well, not too many. In fact, they're all doing just dandy. Nobody's been arrested for it, and they're talking about another one. So if you see what I see, you recognize that to have a good quality of life, you might need to take certain actions, more than is normal. Inertia will kill you. You're already lost by the time the police are coming to your door for a Facebook post, because you shouldn't be in a nation where that happens. So what are you doing? Well, we specialize in reset, wealth building, wealth retaining in these totalitarian times. And there's far more that you might need to do. And you can do one thing a day, small little things, make a phone call. But by starting the process, even if you never get to complete your full plan, but you put certain things in motion, you will be significantly better off than the average man. Also, by taking action, accepting this is the world you were born into. Here's the game. It's been laid in front of you. You didn't get to choose this particular game, and that's the gun you have. Play the game out. Do the best you can with what you got. You've been dealt the cards you've been dealt. You were chosen for these times because you can hack it. So start taking action, and you start right now by watching the Market Sniper, the Crypto Sniper, booking a call, and starting doing the full financial preparations that you need to do in wealth building, wealth retention, wealth protection in reset times. And the average everyday independent financial advisor advice, which is passed and filtered through the FSA or whatever, all these different bodies, is absolutely worthless. The debt market is in real failure. The fiat and debt market's in real failure. We expect in the long run interest rate spikes. How you can profit from these events, because there will be huge opportunities with this major shift from our old into the new. How to exploit those. And that's our speciality. And if you want to book a call, themarketsniper.com is where you'd go. Thank you for having me on. I've really enjoyed it, Danny.
Yeah, likewise. We'll have all those links down below. So if you guys are interested, be sure to check them out. Link in the description. Guys, hit the like button if you enjoyed this video. Comment, go Francis, go in the comment section if you enjoyed and agreed with what Francis had to say. But if you disagreed, let me know. Let me know what you disagreed on. Really interested to get your take here. And with that said, I'll catch you in the next episode. Bye, y'all.